Welcome to this tutorial on Dailypay and taxes. Dailypay is a financial technology company that allows employees to access their earned wages before payday. The question of whether Dailypay factors in taxes is an important one, as it can impact the amount of money an employee receives and the taxes they owe. First, let's understand how Dailypay works. When an employee uses Dailypay, they are essentially borrowing money from their upcoming paycheck. Dailypay then deducts the amount borrowed, plus any fees, from the employee's next paycheck. Now, let's talk about taxes. Dailypay does not factor in taxes when calculating the amount of money an employee can borrow. This means that employees may need to set aside additional money for taxes when using Dailypay. For example, if an employee earns $1,000 and uses Dailypay to access $500 of their earnings, they will still need to pay taxes on the full $1,000. It's also important to note that Dailypay is not a lender, and the money borrowed is not considered a loan. This means that employees do not have to pay interest on the money they borrow, but they may still need to pay fees. These fees can range from $1.25 to $2.99 per transaction, depending on the employer and the employee's pay schedule. To use Dailypay effectively and avoid any tax-related surprises, employees should follow best practices. First, they should understand their tax obligations and set aside enough money for taxes. They should also keep track of their Dailypay transactions and fees, and adjust their tax withholding accordingly. Finally, employees should review their pay stubs and tax returns to ensure they are not under or overpaying their taxes. In conclusion, Dailypay does not factor in taxes when calculating the amount of money an employee can borrow. Employees should understand their tax obligations and follow best practices to avoid any tax-related issues. By being informed and proactive, employees can use Dailypay to access their earned wages while also managing their taxes effectively.